Welcome to This Week in Intelligent Investing, where we examine timely and timeless investment topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Chris Bloomstrand, Phil Ordway, Elliot Turner, and other thought-leading investors. Brought to you by MOI Global. And now, here is your host, John Mihaljevic.
A very warm welcome to everyone listening to another episode of This Week in Intelligent Investing. It is a real pleasure to have all three of the guys with me now, Chris Bloomstrand, Elliot Turner, and Phil Ordway. This week, since Chris didn't join us the last couple of weeks, he's back. We're going to have him go first. Then we're going to go to Phil and finally to Elliot. Each has a great topic picked for today, and I look forward to the discussion. So without further ado, Chris, I'm going to turn it to you.
Yeah, thanks, John. Good to be back with you guys. It was nice to get myself out of town for a little bit of business last week for a couple of days and see some folks, clients. It's been an odd year being cooped up, but miss being on with you guys. Both the recordings, both weeks of the podcast were terrific. I regret having missed all of the conversations about sports, but sports being an unending thing and the final, never over until the fat lady sings. I suppose there's more we can chew on over the ongoing weeks and even today. I thought I'd talk about, given that this is October 15th, and for those that cannot get their act together any sooner, it's tax filing deadline here for extenders. So I just, before we got on, signed my e-file on the tax return and had been spending too much time with our accountants. But I thought what I do, since we're in an election year, is just kind of think through some things that may evolve if we get any changes in the structure of the White House and the Senate. I think it looks like a foregone conclusion that the House of Representatives is going to stay firmly in control of the Democrats. And, from my perspective, as kind of just an observer of politics, I try to not immerse myself. I was more a fan of politics when I was a kid. I try to stay fairly neutral. I'm very conservative on things like fiscal. I find myself very kind of socially liberal. But of the things that matter as an investor, I think a lot about federal deficits and the size of our debt, which are problematic. And, we're sitting here in the middle of a pandemic and we never would have predicted it. And you kind of think through what the deficit was going to look like going into the year. Projections were for about $1 trillion and on what was going to be a economy of north of $22 trillion. Deficit spending of north of 4%, which to me is far too high. You'd rather have a deficit run at 2 or 3% of GDP, in my opinion. And so we were already going to run a deficit. As it turns out, here we are with unemployment up and business activity down, industrial production down, the huge involvement by the Treasury and the Federal Reserve. And so wound up, instead of running $1 trillion deficit for the federal fiscal year, which ends September 30th, we ran north of a $3 trillion deficit. And here we sit watching the White House and the House Democrats volley back and forth between the next round of stimulus. We're not yet clear of the pandemic. And so, we've got this thing bracketed now between $1.8 trillion and $2.2 trillion. So having run a deficit at 15% of GDP last year, which was, well above the 10% that we ran at the depths of the Great Recession, rivaling levels run during World War II and World War I, it sure looks like we're not going to run any kind of fiscally prudent fiscal policy. And we can argue about the merits of whether we need more stimulus, not need more stimulus, but then you come in and overlay, changes to fiscal policy. The Fed on the monetary side looks committed to backstop households and business. You've had Fed officials here in the last handful of days give speeches about, potentially never being able to extricate themselves from supporting the Treasury market and perpetually financing deficit spending. And one of the great fears that I have is that we can't reduce the scope of government in terms of its involvement in fiscal and monetary affairs. and that we run budget deficits at it and above the 5% level from here to eternity. So if you go back a couple of years when we passed the TCJA at the end of 2017, I think what people lose sight of is a lot of those changes were not permanent. Now, the big change, cutting the marginal corporate tax rate from 35% to 21%, that was a permanent change. But a lot of the big drivers of increase in corporate profits came from things like the accelerated depreciation on steroids. I mean, anybody spending CapEx was allowed to depreciate fixed assets in a single year versus, over the life expectancy of the asset. So 40 years at 2.5% a year of full depreciation. Well, that depreciation benefit has been and will continue to be structured to phase out. And so you were going to lose some of that in 20% increments beginning in 2023, and the whole thing was going to be done by 2026. The TCJ eliminated the corporate AMT plan or AMT taxes, which is a big deal. We taxed undistributed foreign earnings at rates of 8% on cash. I want to say it was 15 or 16% on equipment. And, we were spreading that tax over a period of 8 years. And so a lot of that was slated to go away anyway. We have a Biden proposal. I think if we have status quo, which is always my preference, I'd always rather see a divided Washington. I'd rather not see the Republicans control the White House and both chambers of Congress. I'd rather not see the Democrats control both chambers. So, if you think through, kind of a Democratic win in the Senate and also a Democratic win in the White House, and you look at the Biden tax proposal, to me, it's a pretty big tax increase on corporate. And the majority of the TCJA, as you guys know, was geared toward the corporate. I think in my personal world, I don't think I had a tax cut. I think if you lived in a higher tax state, and our marginal rate in Missouri is 6%, if you live in a higher tax state, and you guys know this because you both are, I think individuals that made a decent amount of money had a tax increase. I think I was probably neutral on the cut, but the majority of the benefit inured for the benefit of corporations. And we've got a Biden proposal that looks to be scored at raising on the order of $3 trillion in taxes over a 10-year period of time, split pretty evenly between businesses and households. And the preponderance of the household side falls on those making north of $400,000 a year. And you've got an increase in long-term capital gains rates, doubling from 20 to 39.6%. Ditto that for dividends. There's a lot that's onerous for those that make money, who happen to be those that employ people in this country. But you go back to that marginal rate, which had been cut from 35 to 21. There's a proposal to increase that rate to 28%. Well, you can take the profits of that are generated domestically, and you saw an immediate benefit to the bottom lines of companies that generate large amounts of profits in the U.S. Costco's was very clearly beneficial and easy to estimate. That has not been competed away yet. Berkshire Hathaway, with the majority of its profits generated domestically, was a huge beneficiary. So just the math on cutting from 35 to 21 was effectively, about a 21.5% increase on the portion of profits that were earned in the United States. So, if you do the inverse of that and you increase rates back to 28%, that's about a 9.5% tax increase. So if you take the S&P 500 and roughly half of profits are generated domestically, half abroad, you're looking at about a 5% cut to the bottom line. But then you layer on reintroduction of the alternative minimum tax on book profits north of $100 million. You've got a global intangible tax on income that doubles from 10.5% to 21%. There's a lot there that just the 21 to 28 is scored at $100 billion a year, $1 trillion over 10 years. And so, I think what you'll see Wall Street do, and you'll see investors do, is try to figure out who's going to benefit from the tax cuts, who's going to benefit from any tax increases prospectively under a Biden plan. You got to roll up your sleeves and do the work. But what gives me pause and causes me great concern is that, we change tax policy at times where, the net result can be punitive to the overall economy. So you take, federal revenues under the TCJA for the last handful of years revenues did go up despite the tax cut in rates, but not by much. But the problem we have is a spending problem. We cannot get our fiscal house in order, and it does not matter for the last 40 years who occupied the Wall Street, who occupied both chambers of Congress. We have a massive spending problem in government. And as I pointed out earlier, I just don't know how in the world, running, federal debt that's now going to run at 140% of GDP, how if we're going to run perpetual deficits north of 5%, we're probably going to run another 10 to 15% for 2021. I don't know how the government, how the Federal Reserve extricates themselves from the economy and we get back on a footing where we can run modest deficits and grow nominal GDP at a healthy clip. I think we've kind of boxed ourselves into a corner. And so just, this being tax week for me, just a lot of thinking about taxes, and would be interested to get you guys' perspectives on, who may be some beneficiaries and who may be harmed to the extent we have any changes in tax policy prospectively.
Yeah, one of the unfortunate things about the timing of the tax TJCA was that, it came well into an expansion when, if a recession were to have happened, we probably should have used the ammo then. And sure enough, you end up a couple of years later with COVID needing to aggressively deploy the federal balance sheet. And, then here we are. One of the interesting things, though, I think a lot of the kind of market leading companies today, and by market leading, I mean the ones that have been performing well and pulling the market up, they had not really paid the statutory tax rate at all for as long as I'd known them to exist. And, some of these companies actually manage themselves to not make money so that they don't do it. But the ones that actually do make enough money, think of like Apple, they were never paying the statutory rate. So I think for a lot of companies, it's not necessarily going to matter that much. But then there are, I don't really know. I didn't pay enough attention to where things are going. But for a lot of partnerships, there were meaningful benefits being able to treat certain, call them self-practicing or really small businesses where they're more like job-like than business-like at the corporate preferential rates. I feel like there could be a lot of pain in those kinds of things. I don't know. What are some areas you maybe let Phil take a crack at this, and you as well? What areas you're thinking are going to be the biggest beneficiaries or pain points?
I don't have a great answer to this, unfortunately. I mean, I've thought about it a little bit. I probably spend less time thinking about taxes and tax policy and the implications than a lot of other people in this industry do. Certainly, I think, which you pointed out earlier, Chris, the implications from 2017 were pretty immediate and pretty clear for businesses like Costco. I'd also point out in the U.S., domestically focused and chartered banks. Certainly, I mean, they were, kind of the last vestige of larger companies, public companies or otherwise, that actually paid a full tax rate rather than offshoring a lot of things and using various avenues at their disposal to lower their actual cash tax rate. So, yeah, I don't have a strong view as to which way this will go. I mean, I'm with you that it does seem like the horse is out of the barn in terms of viewing the world as a somewhat of any exercise in fiscal discipline, let's put it that way, is not in vogue right now in either party, I don't think. And what happened earlier this year where, the economy came to a screeching halt in a very short period of time and we mailed out checks to a lot of people. And, that I think rightly was viewed as the appropriate move at the time by many people, not perfect, not without its problems. But I think the fact that it happened and didn't lead to even worse outcomes probably pushes us further down that road, at least in the short and medium term. And where this all ends up, when you start to actually look at the numbers, and you have to do it in a relative way, right? Relative to the size of the economy, relative to the size of the country, relative to the rest of the world, it can be hard to wrap your head around it and figure out where this might end up in 5, 10, 25 years. It's tough. I certainly don't have any strongly held convictions in that regard.
Yeah, I think the struggle is a large part of TCJA on the corporate side of the ledger really only put us on par and on a more even footing with the way the rest of global business was taxed. Elliot, to your point, we did not have all of our businesses paying the 35% statutory tax and then another 3 or 4 when you throw in state taxes. A lot of businesses do, retailers, but places where you have R&D credits, what have you, they were not. Clearly to the extent profits were earned abroad, you didn't have tax that level. So going into 2018, in prior years, the average marginal tax rate when you took just the broad swath of the S&P 500 was 26 or 27%. So we really have driven it down to 21. And, the places I mentioned that were the big beneficiaries are those that had the ability to increase capital spending, benefit from that accelerated depreciation, and, drive profitability. And if you had a useful place to spend CapEx that was accretive and that earned good returns on the capital spent, that was a huge beneficiary. If we don't extend those depreciation tax benefits, you've got to worry that we see a backing off. And again, I think we have a federal spending problem. You look at the years of history, and federal spending does not go down. We actually had a 4 or 5 or 6 year period of time where we had sequestration, which ran off, and so that fairly did keep a check on federal spending after the Great Recession. But that when that rolled off, and we introduced TCJA, and we did drive up federal revenues a little bit. I mean, unemployment levels got down to record lows, and I think the White House takes credit for policy decisions, and more of that was on the back of a strong economy. But we actually did have a nominal increase in federal revenues despite the cuts in tax rates, if you will. But we never got a check on spending, and to the point of being late in an economic expansion by never getting a handle on your outlays. Then when you face yourself with a deep economic downturn, not necessarily in a pandemic, but just a deep recession, we didn't run the federal ledger back down to a reasonable level. And so we've simply just layered on more and more deficits. And now here we are in crisis mode. And again, I don't know how we extricate ourselves. It's until we get a handle on spending, and you look at the big places where we spend money. 2/3 of federal spending is mandatory. We have demographic issues with the retiring of the boomers. Social Security spending is not going to go down; it's going to go up. Having just done my taxes and looking at my healthcare premiums, I can tell you it is absolute insanity. And we're going to have a case in front of the Supreme Court here right after the election. If you paid any attention to the hearings with Amy Coney Barrett, she'll be sitting for, some level of ruling on Obamacare and the ACA. And the problem I struggle with is, if I take the amount of money that as an employer and effectively self-financing my healthcare, I'm not self-insuring, I'm paying both sides of the premium, at $2,000 a month in premiums, $24,000 a year, you layer on a modestly high deductible plan with a deductible of $6,000 or $12,000. I mean, at $6,000, you're looking at $30,000 before you utilize healthcare. Well, if median household income is $60,000, it is insane that half of median household income is going to pay for healthcare before you spend $1 of service. And so until you make the payer the patient, and I've gone off a tax policy here, but until you make the payer the patient, it's just irreconcilable. I've said for 30 years as an investor that we could not continue to increase healthcare spending and education spending faster than GDP forever. And yet every year of my existence, we've done exactly that. And so I fear we're getting to a tipping point, and we start playing around with tax policy at a point where the economy is in no shape to tolerate, much move at the margin. And if we don't have a willingness in Washington by the legislative and the executive branches to rein in spending where we can, we've just got a problem. So I've ranted because I'm always in a foul mood on estimated tax days and on my tax filing day. But, I don't see how to extricate ourselves. And, the easiest place, kind of to get back on point of trying to figure out who's going to win, who's going to lose is, if we're going to indeed raise the rate from 21 to 28 and the AMT comes back in, I mean, you can measure where taxes are paid. And I think it's fair to say the overall stock market, just broadly speaking, if we had an immediate 10% bump from after-tax profitability, you're apt to have about a 5% hit And at whatever point that gets baked in or not, I don't know. We don't invest that way. I don't invest based on, tax policy, tax rates. But I think if we kind of go back to, and we're not even, it's not even to say that if successful, they move the rate from 21 to 28. It's not inconceivable. They take the corporate rate back to 35%. And, at that level, that really is punitive to the bottom line. Some of these phase outs of the TCJA absolutely not only affect the bottom line, but operating cash flow. And so again, some of this was already going to expire. And we have a federal government that's out of control on the spending front. I get having to do it during a pandemic, but I don't know how they stop. And, somebody smarter than me and somebody smarter than the four of us are going to have to figure out how to put a rein in on federal spending. And I just don't see a good solution.
And here we are, most of us still waiting for Infrastructure Week, which was like the one promised spending program of the last, 4 years. So, yeah, I mean, it's a tough spot. It's interesting. I'm of the camp that don't believe deficits matter too much, and there are ways to handle and work through these problems. Like you mentioned, most of the spending is automatically kind of triggered, so to speak. Like there's not much discretion over it. A lot of the discretion is at the margin, or really, places, something like you could lower military expenditures. But overall, there's a lot less room to maneuver than should be, or than one would hope to have. But, it really depends what's done and how the extra tax revenue is treated. If it does go to something like infrastructure and is allocated in a way and kind of spent in a way where it's more investment than pure expense, you could end up in a pretty good virtuous cycle. But, it remains to be seen exactly how that would go. And one of the things I always wonder about is, I'd seen workups in 2008 when it was far more hot button topic, but it does make sense to increase the deficit at a certain amount per year when you think about cap structure optimization in a corporation. People are a little more sanguine taking on debt than they are speaking or thinking in that way in government terms. Like if you were to look at the balance sheet in aggregate of the U.S. federal government, we hear a lot about the debt, but we rarely hear about the assets and the powers and responsibilities of the government that come with it all. And they're considerable assets, and they're things that, if push ever came to shove, could be used to kind of offset some of the obligations. But, hopefully we never reach that point.
Well, revenue, spending, deficits, and debt should all be measured in my book as a percentage of nominal GDP. And the struggle I have is we have not produced strong top-line growth coming out of the Great Recession. Nominal GDP grew by about 3% a year. Sales at the S&P 500 grew at about 3% a year. And so running deficit spending.
But you wouldn't do that with a company, right? You wouldn't say you're measuring their debt balance against their, obviously you'd look at their coverage ratios on their income and whatnot, but you'd also look at it relative to the balance sheet.
Well, no doubt, but you can't grow debt faster than the business itself grows in perpetuity, or you're going to run into problems during an economic downturn. I mean, regardless whether, tax policy is going to wind up, reducing deductions measured as against EBITDA versus just EBIT, which is coming soon. You can't grow debt faster than the top line. You've seen too many businesses do it. I think properly, a deficit spending has been proven to be manageable, but only manageable relative to the underlying growth of the economy and the size of the economy. Again, I think if we're not going to grow nominal GDP, or better put, real GDP, if we'll have very little growth in real GDP, maybe 1 or 2%, you ought not continue to grow debt and deficits faster than in a real basis, 1 or 2% of GDP. We're already at the point where we can't service our debt. We're already at the point where, the Fed's talking about never being able to move short-term rates, for the foreseeable future at least, but perhaps never off of the zero bound. We will never in our investing lifetime see interest rates back at 5 or 7% of GDP in a normally functioning economy. Debt levels are so high when you introduce then household debt and corporate debt at 400% of the economy, we can't have nominal interest rates at levels that we would have been used to in our earlier lifetimes. We have to run them at zero. And when you run them at zero, why not continue growing spending at 5 or 10% a year? We've just got, we've baked ourselves into what's necessarily going to have to be continue massive transfer of wealth from those that have capital to those that don't. And believe me, if we're going to run 5% deficits in a world that's not growing, effectively this becomes debt monetization. We've talked about that in past, and I've talked about it in past letters. But my more broad fear is that the Fed cannot extricate themselves from financing all of deficit spending, most or all of deficit spending. And if we don't have the willpower to rein in spending at some level, then we are going to have a transition of wealth. I mean, the only way to pay for federal spending and debt, new Treasury issuance, is through tax policy or through inflation. And, if you take the Biden plan, and we are going to raise taxes both on, folks making money and on business, and we're really going to raise an incremental $3 trillion above and beyond what was projected and scored. In an economy that doesn't grow, that's problematic. And so, we're looking at a big redistribution of wealth, and we're looking at simply, maintaining sustenance spending. And I've got a problem with that. I've got a problem with that because as an investor, you broadly can't have nominal GDP, and you nominally can't have the top line not growing. And you get to the point where federal spending and government debt loses its efficacy. There's very much a law of diminishing returns, and I think we've passed that point in the last handful of years. And so, to the extent we're going to spend on infrastructure, you take the broken window theory. You break a window. I mean, it impacts and it benefits the glazier, but that's money that the baker whose window was broken that does not have the capital to spend elsewhere. And so, if we're going to spend money on infrastructure, it's got to come from somewhere. And on a net basis, it's not accretive to GDP. So I'm very, very, very concerned here during an election year that the lack of willpower and what I've seen in the last 4 decades from all politicians on the spending front is just problematic. And you're right. There's very little that can be done in terms of mandatory spending, but if we're not going to grow the top line and we're going to continue to increase spending, we're going down a path that's not very good from an investment standpoint. And that's my overarching fear.
Yeah, on the one hand, I don't ever want interest rates to get to where they were when I was younger, having been born in '82. But on the other hand, I think the monetization of debt is a real reality we might have to face going forward. And I think it was notable when Powell said he'd be willing, and this was something Yellen wasn't willing to do, to let inflation overshoot the 2% target for as long as it has undershot it. So we've almost had the reverse of what in nominal terms, what should have been over the last few years. God, it's almost a decade now. So there could be some considerable time where they let things get a little hotter. And, in terms of investment in those kinds of regimes in the past, equities have actually been an all right, pretty good place to be, both on a relative and absolute basis. It's some other areas that you definitely want to be fearful of, but it's something, we all got to think about.
Well, hopefully we don't go down the path of having to consider what's happened in the Venezuelan stock market and Caracas. A great outcome, because at
least we're a sovereign issuer. It's a little better in that situation.
Yeah.
The only thing I'd say is I agree that there's been almost no reason for hope on this front in the last several decades, and we've still made progress. The world's still made progress, and that's an anecdote. It's not something I would really want to bank everything on. I agree there's plenty of reason for concern, but I also think we tend to push things a little too far in one direction and then actually get up to the edge of the cliff and sober up a little bit. And I think that could well be the case here. And then circling back to the healthcare topic, which I think you mentioned earlier as being related, I totally agree. I mean, yes, there was an issue of international tax comparability and competitiveness. But if you look at how the U.S. healthcare system is structured, I think pretty much everybody would agree that it's insane and needs to be fixed. Now, how that's done is obviously the much harder question. And there have been some high-profile efforts run by people a lot smarter in this area than I am in anything that haven't gone anywhere. So I'm not saying there's an easy fix there, but there's 6, 7, 8 points of GDP going down the tubes because of our healthcare situation and the tax on business, because most plans are sponsored and sort of the waste that's embedded in the system on top of it. So if we can fix that, I'd immediately become way more optimistic on a range of fronts. Until then, I don't have much to cling to in terms of hard data or logic or reason other than hoping we don't ever actually take that step off the edge of the cliff, wherever the line may be.
What are your thoughts, John? European perspective.
Yeah, thanks, Chris. I guess I'm kind of jumping in from 10,000 miles away and from a country where I've lived now, and that's Switzerland, for the last 10 years. And believe it or not, I still don't know the name of the president of the country or the head of government. I'm not as ignorant as this might sound, but that is how this country works. They've kind of settled the big issues, and they've got a technocrat government, and you don't hear the name of the head of that government that often. And actually, you don't have to know it. So it's just a really stark contrast to kind of listening to US news, where you really cannot go for 5 minutes without hearing, some names of the candidates and so forth. I recently had a really interesting letter hit my inbox from Sri Viswanathan at SVN Capital. And he included a chart there on the stock market performance under Democratic and Republican administrations since 1900. And it was like double the performance under Democrat administrations, which maybe goes a little bit against what we might expect, but actually it's done better. But the big point that he was making is, if you had actually been in the market just during Republican administrations or just during Democrat, you wouldn't have gotten even 10% of the total return that you would have gotten if you had been in the market the whole time. So I think sometimes maybe we make too much of these kinds of things on the political side. There's enough kind of structural gridlock in Washington and enough power that the special interests and lobbyists have, that I'm not sure we're going to see any huge changes, barring a real revolution. And I don't think that's really on the table right now. So I guess I'm pretty sanguine about kind of the economic outcomes. Don't really want to get into any other outcomes in this discussion, because that could get a little messy. But I think everyone listening knows where Europe stands on Trump and so forth. Yeah, that's pretty much all I'd have. So I think unless any of you guys want to jump in, we're probably ready to move on to Phil for his topic of the week.
Sure. I have a much lighter topic this week than that discussion. So hopefully this will be informative and entertaining in a different realm. So as we were just discussing, we had an interesting conversation about, Elliot brought up the concept of a post-hype sleeper, and we kind of got off on a digressive course of analytics and sports and how it pertains to investing. And I was circling back on an article I read about 3 years ago, which really has stuck in my mind. And it was brought back to my attention this week, or maybe about a week ago, with the news about Billy Beane, who we talked about is kind of the second godfather of the sports analytics revolution after Bill James really pioneered it several decades ago. And it's amazing to me how slowly that actually built speed, and how some really obvious things, the fact that a 3-pointer was more efficient and more desirable than a long two or even a mid-range two. Stealing second base is kind of a low value proposition. Just some really basic stuff that didn't require the advent of quantum computing to figure out. Still took, decades to get going from there. So the news that just came out, in case anyone has missed it, was that Billy Beane's probably moving on from the Oakland A's and likely going to tackle soccer, European football next. With the advent of this, of course, it's a SPAC because everything in 2020 seems to be a SPAC. There's a SPAC called Redbird Acquisition. We'll link to these articles in the S1 in the show notes, but they're likely going to be purchasing the Fenway Sports Group, which has ownership stakes and basically control of the Boston Red Sox and Liverpool, along with some other assets. And so Billy Beane's going to be tackling potentially a whole new sport, one that he didn't play but has been involved with for a decade or more, one that he knows really well. And so what I'm curious about and what I'd like to get everyone's take on is what areas in both sports and specifically in investing in business are still so poorly understood and poorly measured. So I think in baseball, now it's pretty clear that, the Moneyball revolution that Billy Beane ushered in was so effective that now it's kind of played out. It's kind of gotten to use a crude analogy, where quantitative value investing was maybe 20 years ago or 30 or 40 years ago, even, where Ben Graham came along and said, look, if you can buy a company at a net kind of value, it's hard to lose money. And if you hold a portfolio of those over time, you're going to clean up. And that's basically what happened in baseball. So that now I think the clubs that are making the next step have married analytics with scouting and development and taken a very data intensive and objective approach, but it just has to morph. So we're kind of on to 2.0 or 3.0 in baseball. If you look at basketball, probably still in the 1.5 version, between versions 1.0 and 2.0. Again, so the article I was referring to is actually about 3 years ago, written by Ben Cohn at the Wall Street Journal, who writes some fantastic stuff. And I don't know if any of the three of you guys are basketball fans, but you probably know James Harden. He's one of the more prominent players in the NBA. He's been fantastic for years, but he has a very unique style. And when you watch him play, he's not particularly big by NBA standards, doesn't have a particularly long wingspan. He's not brilliantly athletic in terms of his vertical leap or anything like that. Do you guys know the one thing that he measures out at about the 99th percentile of NBA players? Off the top.
3-pointers?
Well, sort of, but not
that's
exactly
where I'm going with this.
So the one weird analytical measure you can capture for him, if you were to, put him through a battery of tests, which they do at various places, where you're usually using floor plates with pressure sensors to measure how quickly you can start and stop, jump, turn and cut, run forward, run backward, all that kind of thing. He measured right in the middle for pretty much all of those things compared to his NBA peers. But the number one thing that he just jumped off the page using the 98th and 98th and 99th percentile was the ability to stop, to decelerate. So most people think of quickness as the ability to accelerate and go from stopped to quick. And instead, he's proven to massive effect that, well, of course, it's more important to be able to stop, because in sports, everybody's in motion, and the ability to change direction and stop is more important than the ability to go from a standing start, 0 to 60, so to speak, because you very rarely go from 0 to 60. And yet here we are in sports like the NFL, where we still measure the 40-yard dash in a straight line. I mean, almost never in football do players run a 40-yard dash in a straight line, right? Not only do you rarely get 40 yards of open space, but it's almost never in a straight line. So it's an irrelevant metric, but it still gets used and cited very regularly. In basketball, you often cite a vertical, where again, you're starting from a standing stop and jumping straight up. Again, it almost never happens, but the ability to decelerate is the reason why James Harden gets so much separation. And I think, I haven't seen the data for this. I'd love if somebody could point it out, but I think if you looked at some of the best players in the world in other sports, particularly soccer, that's probably what separates them as well. You look at a guy like Mo Salah on Liverpool and his ability to create space for himself and score in tight spaces. Certainly Leo Messi is just an absolute genius at that. And that to me is just an example of an obvious thing. It's like the advent of, wait, the 3-pointer's worth more than the 2-pointer. Obviously, the ability to decelerate should be probably the single most important measure of athletic ability. And it just has gotten still. I mean, this article was written more than 3 years ago, and it's been covered, but it still doesn't seem to get as much attention as you would think. And my strong bet would be over the next 5 and 10 years, it'll get way more attention. And then if I look forward to business and investing, if baseball's gone from 1.0 to 2.0 or even 3.0 now, I feel like business and investing is still leaps and bounds and light years ahead of sports. When I look at the ability to capture market inefficiencies and take in massive amounts of data and distill it and find what's really important, particularly as it pertains to short-term market pricing and any particular inefficiencies you might find on a short-term basis that can either be taken advantage of over a few days, a few weeks, certainly a few minutes, any sort of arbitrage opportunity. I mean, it's just game over. And it's been game over for 10 years. I mean, I think the number of times I've seen any sort of informational edge that could be repeated by a systematic process, it's all captured by the handful of primo quants that use incredible resources on the artificial intelligence and machine learning fronts to do that. So I don't know of any obvious analog to the deceleration effect in sports that would apply to investing in business, because I just don't see it's going to be tiny little incremental bits of progress. I still think there's a massive opportunity in business and investing to take longer term effects and opportunities and exploit those, particularly where you can, to extend the analogy, identify opportunity via analysis and then marry it with a development process and a longer time horizon. So you're not just picking off really cheap free agents below what their market worth are and using that to win games. You're finding attractive prospects, potentially younger, potentially in different geographies, not just through the traditional college or minor league routes. And then you're putting them into a more robust farm system, and you have a better framework for analyzing how they may contribute to a lineup. And you just have a more holistic data-driven approach. It's not just one little tiny factor that could be arbitraged away. And I think the same is true in business. And this gets back to what we were talking about with Snowflake last week or the week prior, where some of these leading venture capital firms have actually adopted this framework of finding an opportunity and then actually running it from A to Z. So they find the opportunity, they handpick the investors, the entrepreneurs, the management team, and it's just run from top to bottom. And I think that's the great big opportunity. So I'm curious if you guys have anything that stands out in this regard, either in terms of a metric or a framework or an analytical data point that is still just so obviously underexploited, either in business or investing. Or in sports, I guess, for that matter.
Well, I was trying to jump in. I'd read that on the James Harden, and obviously the ability to stop plus the length of his beard naturally jump out. I think in the major sports, certainly, I think the Billy Beane, the intellectual approach really has been developed. I had a chance here when the Rams were still in St. Louis to spend a fair amount of time with the guys that ran the organization. And they were up to their eyeballs in analytics and breaking the game down. Obviously we have the Cardinals in town, and I think the way they run their farm club system and apply all of the concepts that Billy Beane and those guys did. Batting average, being lesser of a better metric than on base percentage. But football has come a long way, and I'd break your thoughts and comments down maybe into two buckets. One. And it all goes to management style. But you're looking for player type and you're looking for athleticism. And I think football, of all the other sports, has really done an amazing job. The combine will still have offensive and defensive linemen run the 40-yard dash because that's what they do. But when they get into player-specific development and testing, and you do your on-site workouts with a club, you're doing very position-specific drills, unlike what was done even 10 years ago. The Cleveland Browns hired Paul De Podesta, right? I mean, he worked with Billy Beane at the A's, and he's got Cleveland, and I'm not going to attribute it to him, but he's got Cleveland at 3-1, I think, which is probably their first winning record early in a season since probably 1789. You think about the management side of the game and the decision making that goes on at various points in a game. The decision and the probabilities of when it makes sense to go for a first down on fourth down and when it doesn't make sense, when to punt, when not to punt. A lot of those analytics have been done. The sport that's just blown me away, and maybe it's just one dude, but Bryson DeChambeau, who won the U.S. Open.
Yeah, that's a good one.
Was kind of laughed at, by the heavyweights of the game. Brooks Koepka would get on him, I think, kind of in a kidding way, but for the time he would spend over punts or over putts. But you go through and now that he's won a U.S. Open and he's won some big events and he's the odds-on favorite to win at Augusta, a lot of people are stepping back saying, wow, I mean, this is way beyond Tiger Woods getting himself fit and in shape, which the game of golf has adopted. I mean, this guy, if you guys follow golf at all, has just taken this high-tech approach to training and to his game. And it's almost bizarre. You listen to the conversations that he has with his caddy are just wild. And so, they were talking about him at the U.S. Open and his teaching pro for his whole life. And I forget the guy's name, but gave him a book called The Golfing Machine by, I think it was somebody Kelly. And this guy from an early age in his mid-teens kind of adopted this very scientific approach to his game. So, all of his shafts are the same length, which is unheard of. They're all set at 10 degrees upright. All of the heads have the same weight. He's even adopted this concept on when to leave the flagstick in now that it's allowed and when to take it out on putts. He said only at the USGA or only at USGA events, which in his case would be the US Open, he's always going to leave them in otherwise. And so, he points out the fiberglass content in a normal PGA Tour stop is flexible or malleable enough to where you want to bang the ball into the flagstick. He's got a term for it called coefficient of restitution of flagature or some crazy thing like that. The guy's put on, and this is golf. And so you talk about, measuring Harden's ability to stop and change directions in a hurry. And a lot of that gets into plyometric training and explosiveness. But this dude put on 50 pounds since he became a PGA Touring pro. And he weighs something like 240 pounds and said a year ago or so, he wanted to get to 270, which you think about what I'm going at these days kind of gives me hope that, maybe I'll be able to play the game again. But no, it's
what's so interesting, I think, right? Is he said he did that very intentionally, right? So all the other analytics stuff, I agree. Like he's a physics major. He studied the stuff very intensively and the flag stick and the exact trajectory of his ball launch and all the analytics he's done over there. It's fascinating stuff. But I think the major insight is, and the only reason he won the US Open more or less is exactly what you said. Just like people had this aha moment that on-base percentage matters more than batting average, that stealing second base maybe not such a great idea, that a three-pointer is worth more than a two-pointer. His big idea was really taken partially from Tiger less explicitly, was just that the farther you hit the ball, you have a big advantage over the rest of the field, right? So he actually set out about a year ago. He put on that 40 pounds really just during the winter and quarantine. Yeah. And so his big idea, like mine with James Harden and deceleration, as it should apply to soccer and European football and most sports really, is deceleration matters more than acceleration. And in his case, these golf courses that were meant to discourage the bomb and gouge, where you just hit it a mile down the fairway and you miss the fairway, even you gouge it out of the rough. And Winged Foot was supposed to prevent that from being effective, but he proved that was definitely not the case. So, it's amazing to me how much success you can have when you just take one big idea that matters and take it very seriously. And I think that more than all of his shtick about the analytics is what's really separated him recently.
Yeah, force equals mass times acceleration, right? And so
he just got his ball speed over 200 miles an hour in Vegas last week. The ball speed at launch off the driver, and that was a goal, and he just achieved it after about a year of dedicated work. I mean, most of the time, 180, 185 would be considered pretty nuts. And he's hitting them over 200. I mean, he carried a 300 and something yard par 4 last week with an iron off the tee. I mean, it's just stuff we haven't seen before, and it's going to be pretty interesting. So are there other examples like that in sports, or do you think that's kind of one off?
No, I think, all the individual sports, measuring, the swimmers, measuring body type. And there's a lot of, I think we're way, way down the road in terms of the science of sports and measuring the physicality and what's required and just the way folks train. I go back to, sport 20, 30, 40 years ago, and very, very not scientific. You knew how to lift and train, but, you weren't doing as many explosive lifts. And, they figured that out 20 or so years ago, watching the Olympic lifters, and that became, a more integral part of your training. I think, to me, I go up and down the sports that I kind of pay attention to, and I think there's a lot more to it than I think a lot more have adopted, the management style overlaid with the physicality and the proper way to train. And like I say, if they got to it in golf would be the last place. I mean, the Masters, kind of back to DeChambeau, and I'll stop. But I read an article a couple of weeks ago, Golf Digest or one of them, that talked about that he may lose some of his physics and scientific advantage because at the Masters, they don't let these guys use their laser yardage books. That have they have these topographical maps that'll measure a tenth of a degree of undulation on a green, where they're trying to get speed and undulation right. So they're allowed to use the yardage books that have been made by hand, where a guy like Phil, who has 25 or 30 years of playing at Augusta and making handwritten notes when they play the practice rounds and in debrief on the real rounds, that's allowed. So DeChambeau, who's very technical, you listen to him talk with his caddy, and I have no idea what the guy's talking about when he talks about a putt rolling at like 10.5 miles. If it was rolling at 10.2 miles an hour, I would make the putt. And if it was rolling at 10.4, I'd miss it on the high side. Well, who thinks in terms of how fast a putt is rolling on a miles per hour basis? It's crazy. But so we'll see at the Masters. I think, in one event, is a one-off and anybody can win on any given Sunday, but it'd be interesting to see if the Masters lack of using the yardage book impacts DeChambeau, who with Koepka hurt, I think becomes the odds-on favorite to win the tournament.
Yeah, you guys have been talking a little more about the two sports that I follow less than others, but there's some observations I think to tie in that, touch on these points. In baseball, you kind of think about our last 2 weeks on the pod where we went from talking about, we talked about the evolution of Moneyball to this, value kind of transactional approach to finding value versus the value creation approach. I tend to believe that as these that the exploitation of certain inefficiencies, and the more they're done, tend have a way of creating new inefficiencies, and it's up to people to find them. So, like in between the value exploitation and creation phase, we didn't really talk much about like the revolution in pitch framing, in aligning a defense, like a fielding positioning posture with where you pitch toward. And then those create different kinds of opportunities. So, one thing could open other kinds of doors. And there's kind of this period in the middle where you don't necessarily see what the next inefficiency will be, but it's going to happen one way or another. I then also think about hockey, where like there was a pretty damn good advanced stat that's existed for a long time in the form of plus minus. And there are all these new attempts to create different kinds of advanced stats. The favored one is the Corsi, which is kind of like an aggregation of net shots kind of attempted and created versus shots against you. And it's supposed to demonstrate, who's more capable of creating opportunities on net than who isn't. But like at the end of the day, I feel like the simplest stat might still be the best. Like those players who can control the puck and dominate possession while they're on the ice, you're disproportionately advantaged. How do you create opportunities? It's by having the puck. And, on the other side, I think there's some like intangibles that don't really, or really on the player metrics more so than statistic metrics that matter a lot. Like, I have this theory that undersized but highly physical and fast players are hugely advantaged in the league. And I think a lot of the best teams from recent years have at least like a handful of these kinds of players, and some of the best players we've seen in recent generations. I mean, people like Ovechkin and Sidney Crosby, sure, they're great goal scorers and play creators, but these guys are both small yet can play extremely physical at times. So like that's kind of basic, but I think those things are there. And then the third sport that I'd tie in, when we were at Idea Week in February, Jaakko Lusu gave a really fascinating presentation. He works in European football as an agent and works with a club, and talked about just like, I think, I didn't really know enough about the structure of how this all works there. But from a club's perspective, there are really so many different opportunities and avenues to kind of find and create value that don't exist in the US sports. So like teams have the opportunity to advance leagues and become more valuable in doing so. But also teams like existing in certain countries could try to find these monopolies on local talent, or they could send scouts to players where others aren't, nurture that talent and trade it for either pools of cash that they could redeploy into their business, or other kinds of players to kind of accelerate their capabilities. So I think that's interesting to think about from a team and a portfolio management perspective sort of thing. And I think there are places where that could be applied a little more smartly in some of the U.S. sports. And perhaps just knowing about that layer of those multiple layers of inefficiencies is part of what attracts Billy Beane to that world. So those are three different areas that I think about in this conversation.
Yeah, no, I totally agree. And those are great points. I would reiterate, as far as hockey, it's probably the sport I know the least in this context, but I would put, if you're trying to scout players in advance, I think it's really hard, and hockey's probably particularly hard, but deceleration just seems like another obvious one, where if you could measure how quickly a guy can stop, he would just have a major advantage over other players. And maybe the differential in hockey would be thinner than in other sports. I'm not sure. I mean, that would be interesting. And it would be a little bit harder to measure because you couldn't use force plates like they're using in basketball and soccer and football, but it just seems like an obvious one. And just to wrap it up, I mean, my last thought would be, as it does apply to business and investing, just as deceleration would be my one big thought to capture athleticism as kind of the top of mind metric in scouting and player development, mine would be something on the governance and capital allocation topics that we talked about, particularly the conversation we had with Larry Cunningham, because it just seems like still such an obvious area for improvement. You have these great companies led by brilliant management teams that still just don't know how to think about dividends and buybacks and acquisitions and SPACs and IPOs and stuff, where we're just stuck, 20, 30, 40 years ago with some very antiquated processes and measures. So I don't know that there's one metric or one stat or data point that would get us there on that front, but that would certainly be the area where I'd be spending my time and attention and focus.
It's interesting, Elliot, on hockey. You talk to the guys in the game, and they're introducing the science. They're measuring, guys that would have a lower pass completion rate, but they measure it against the passes that are made that give a team scoring opportunity. And I think they borrowed some of that from soccer. But then you just take raw physicality, kind of back to Phil, your point. And, I watched the St. Louis Blues play for years and years. I've been here for over 25 years in St. Louis. And, they would wind up, getting in the Stanley Cup playoffs, which is a season within a season. And they could never make it to the next level. And, you go back 4 or 5 years, and they just got physically beat up by San Jose in a playoff series. In the prior year, I think they got beat up by Vancouver. And so last year, when they won the Cup, they completely changed their lineup over the course of a 2-year period of time and wound up simply building the biggest roster in hockey, not by player number, because they're all set at the same number, but by size of player. And so, they put big forwards on the ice, and they had big defensemen, and they leaned on the forecheck and would dump the puck in the zone, and they would just kick your ass, and wound up kind of coasting through the Western playoffs and getting to Boston, who played a very similar breed of hockey, and wound up going to a 7-game, and it was just a raw physical game of hockey. And so, there where you've known that size matters, and you've known from the days of youth hockey that size matters, and a lot of times that benefited the younger kid, you still go back to, we were losing because of a lack of physicality, and we just simply need to get bigger. And that's not much of a scientific conclusion. That was just watching the result and realizing we need to mass up, and they did it, and won the Cup for the first time in club history.
Yeah, I think that's totally right. And you see that with Tampa, although the one distinction I'd make is it doesn't necessarily require bigger players. Although, Tampa has Hedman towering over the blue line, but they have a lot of smaller but extremely physical players up front. And just having that element, that dimension of the game, I mean, especially when you get to the playoffs and it's more about like wearing down your opponent over a number of games, it makes such a difference. It's like it's the biggest game changer. But being able to dominate possession empowers you to be on the forecheck more too, though, and take that pressure to them. As physical as you are, if you're standing on your heels, you can only, use your power so much. So it's been weird seeing the evolution of the game from like the early 90s when the power forward emerged and, really clutching and grabbing and kind of slower game took shape to a wide open game after the second strike. And, I still think, every time you have these situations where there's a huge amount of change injected, it takes years to find a new equilibrium. And we're not quite there, but definitely starting to see a recipe that's like repeatable in the NHL. Though you can't, like you're saying, you can't substantiate it or follow it very cleanly with any advanced stat yet.
Well, it's a fun topic. I'm glad you guys brought it up over the last couple of weeks. It's, I'm sitting here conjecturing that, we've already adopted a lot of the science and maybe there's not that much more to go. And Phil, you made the point that there's a correlation perhaps to the investing world and, perhaps we've exhausted a lot of the advantage. But, at the end of the day, it's going to be fun to watch the evolution over the next 5, 10, 15 years in sport in particular to see, I bet we'll have the same conversation 15 years from now and realize that we were just in the infancy in the year 2020.
Well, that's true. Yeah. So that's where I think it's interesting. I don't know what the next, technological advance will be to capture better data. I mean, the high speed, high resolution cameras and some of the stuff in all these sports were unthinkable 10 or 20 years ago. And I'm sure that'll be true 10 or 20 years from now. And I do think the evolution is continuous. It will by definition never stop. And you're right. We could definitely have this conversation 5, 10, 20 years from now. And I hope we do. I just think that it does have to evolve because just as with Ben Graham's net nets and classic book value style and value investing having reached the end of its useful life many decades ago, I think you saw that with baseball with the Moneyball 1.0. And so baseballs had to move on. And it's just the part of it that's interesting to me is I don't know quite exactly what's next, but there are some big ideas that stand out as close to no-brainers. And in some cases, they're actually pretty slow to reach widespread adoption. So where that happens, I think there's a real opportunity.
Well, you can have all the data and all the analytics in the world, and you can make the case in sport, you can make the case in investing, but management style and in the investing world, capital allocation and management, there are some CEOs and management teams that get it and do it right, and you have teams that run near identical businesses that don't do it well. So just an awful lot of value can be added based on how you interpret data and how you block and tackle. At the end of the day, sport's all about blocking and tackling, and businesses and investing are all the same on that front.
Music to my ears as a Jets fan. Definitely, we see that in action every week. Or the lack thereof,
I'll jump in real quick just because maybe a little bit of a European football perspective here. I think, everything you said, Phil, is spot on. And I do agree that we're starting to get to the point where, at the level that's visible to an audience, meaning how players are put on the field and kind of where, what positions they have and so forth, we're getting pretty smart in most of the big clubs. It's getting pretty efficient, but I think there's still a ton of inefficiency to be exploited. And that goes to the comment that, 10, 20 years from now, we'll look back at this and realize just how little developed this actually was. And I think the inefficiencies, come the further back you go kind of away from what the fan sees. So that can be in actual player development. I think, Elliot, you kind of alluded to this when you talked about the MVP machine last week. It's not just about, buying undervalued players, putting them in the best positions on the field, but it's actually about developing players in a really cost-effective way. So there's still, I'd say, a ton of inefficiency there. And then as you go back in time of a player's development, there's just a ton of inefficiency. I mean, you can just think of basically a player not when he's ready to play in, the first team of a Liverpool, but when he's in an under 15 team. There's just so much inefficiency at those levels in terms of scouting, developing those players. There's also, I think, some good points in a book by Malcolm Gladwell where he kind of talked about how in a lot of sports, the top players tend to be born earlier in a year, just simple calendar stuff, like January 1st.
It's definitely true for hockey. Yeah, that's for sure.
Yeah, you're going to find a lot of players born in January, February. Why? Because in those youth teams, those extra few months of age make them bigger and more powerful. And then they get coached more, they get more opportunities. And over time, they are better players. So, one way to kind of fix that, obviously, has been to give those guys who are born later in the year more chances in various ways through these youth development programs. Because if you weren't aware of that, you'd actually end up not developing a lot of players that could end up being great players. So, I do think we're gonna see a ton on that front. Actually, I follow European football quite closely because my son is in one of the youth development programs. He's 14, and if you Google on YouTube, just one kind of little interesting thing to look at, because there's always these new theories coming out about what's the future of football, and there's now this Paris Saint-Germain under 19 coach called Thiago Motta, who has this 2-7-2 formation, and it's being hailed as potentially, not necessarily, but potentially the future of how European football will be played. And as part of this 2-7-2 formation, he actually views the goalkeeper as a midfielder. Now, it's kind of crazy stuff, but you can Google it, and there's some really good kind of video explanations of that on YouTube. So I think we're just scratching the surface, and it'll be really interesting to see where that goes. And obviously, there's a ton of investing analogies as well.
Yeah, and I think that's probably why somebody like Billy Beane would find it so interesting, because to your point, there's not 9 players and it's not a static start-stop. You have a discrete play. In that sport, you have 11 players instead of 9, and the play never really stops for at least 45 minutes. And so it's this continuous flow of data that can be harder to capture and harder to tweak or change, the outcomes based on your read of that data. But if you can get that right, the implications are massive, because it's an enormous sport, tons of money, and there's just so much inefficiency there. I don't know about a 2-7-2, but that's kind of where I was going. It's like, at least my read of it is like, again, baseball's implemented these massive shifts on the defensive side, and European football and soccer seems to have not quite been as dramatic. Even basketball, right, with some small ball lineups and some stuff, has made some pretty interesting changes. American football seems to have been a little slower on that, whether it's going for it on 4th down or whatever. It just seems like they're a little bit less radical in their willingness to change things. But we'll have to see. I don't know. It's fascinating stuff to me.
Well, except football is a copycat league, and at the pro level, the college level, down to the high school level, if something works, it gets widely adopted pretty quickly, and that's probably the same for most of sport. I think that's probably the case in the investing world as well. You get an offensive coordinator that gets some advantage with a new play scheme or a new formation. If it works, the defensive coordinators have to adapt. And once the DCs adapt, then the offensive coordinators have to make the next subsequent change. It evolves. I'm fascinated to see how the Cleveland Browns franchise evolves. Like I say, with Dave Podesta there, sitting at 3-1, it'd be fun to get, if you guys follow football, what your predictions are for their end of season record, because he's been on the scene now for 3 or 4 years, and he's got some player personnel in place. And I think a coaching staff in place that's better than Cleveland has had in years past. And at 3-1, I'd say, I bet they make the playoffs and they wind up at 10-6. But it'll be interesting. But I think the core of that franchise, for some of the Billy Beane philosophy that he brings to the game, if they wind up being successful, to the extent the NFL is behind the curve, they're going to catch up in a hurry.
Terrific. Well, thanks, guys, for that discussion. Let's move on to Elliot for our third topic.
All right. So with the House antitrust report, one of the when this whole potential break up the tech companies idea started emerging, I decided to read into the history of the AT&T breakup, thinking it's like one of the recent examples of this, more recent examples of some drastic antitrust breakup of a major company in cutting edge technology. I know we don't necessarily think of AT&T that way, but at a certain point they once were. And there's a great book by Steve Call, might be mispronouncing it, The Deal of the Century, The Breakup of AT&T. It's not exactly a page turner, but it's a really interesting, detailed history on the whole backdrop to the AT&T breakup. And I think one of the underlying plot themes throughout is this idea of unintended consequences. So much of how the industry ended up in this way, and so much of what happened afterwards was really not the obvious of what you'd anticipate happening. So the background to the story, it starts with kind of a history of William McGowan and MCI and what they were trying to do. There was, deregulation where MCI was given an opportunity to compete in long distance, and they did this at a lower price. And it all happened amidst a backdrop of AT&T while facing rising inflation, kind of underinvesting in CapEx and, not really making their network quite as strong as they had over, the preceding decades. And so the way AT&T's business model worked was that short haul, so like local calls, was a loss-making business. And long distance was where they actually made the money. So they had their loss leader that facilitated the long distance. And it was such an integrated system to the point where you actually didn't buy a telephone. You leased your telephone from AT&T and connected it to, the lines. And AT&T really did everything. It was a true monopoly. And, it's interesting to think of actually renting your phone from the company in that sense. But, that's where things were. And one of the consequences of AT&T's structure as a regulated monopoly is they weren't allowed to sell computing equipment, or data services after a 1956 antitrust settlement. And what I find interesting about that is AT&T and Bell Labs had like one of the foremost research institutions and was going as far in advancing technology in those spaces as anyone, but they couldn't really monetize, they couldn't really commercialize or deploy some of that technology. So it kind of idled and was more like, call it pseudo, like university-like in that sense. So after MCI filed for IPO in 1972, they started negotiations with AT&T for like how best to access these local networks, because you had to access the local network in order to be able to serve long distance network. And AT&T was really playing hardball because they understood the reality that if they gave MCI access to their local network, and MCI got to sell long distance to those people, well, AT&T would still have the loss leader, but they wouldn't have the revenues on their actual profit pool. So, they understood how that imperiled their business. So they were demanding like a CapEx contribution from MCI to support the local metrics. And MCI decided to play hardball and sued. And the DOJ eventually sued. And all this was amidst a backdrop of increasingly deregulation-oriented judiciary, deregulation-oriented DOJ, and just about every part of the government and administrative bureaucracy was kind of focused at this time on moving towards a more deregulated economy in general. So like AT&T started realizing they had to decide what they wanted to do to protect their own P&L. They started advancing this idea amidst the lawsuit. And by the way, the lawsuit started in 1974, I think it was. Towards the end of these negotiations, these negotiations went on for about 6 to 8 years. They started putting forward this idea of splitting off the local telcos and making them independent public entities, and keeping everything else at AT&T, under the premise being you get the loss leaders out of there and you still hang on to your profit pool and you start squeezing MCI for access to the local networks. And, both AT&T and MCI as long distance carriers would have to pay for access to the localities. AT&T thought they were getting the best businesses. And then, like I introduced up above, unintended consequences, everyone ended up in a very different situation than they thought they'd be when all was said and done. So, the kind of story kind of ends with this idea that the locals were already in their first 2 years as independent public companies exceeding all expectations on how profitable they'd be. And AT&T within 1 year already warned on its profit. They weren't able to earn their 12.75% regulated ceiling on ROE. MCI, who kind of advanced this action, saw their stock lose 2/3 of its value because they started having to pay dollar for dollar what AT&T paid for access to the local network. So it went from $250 to $500 per customer to pay for that access. The baby bells were split off. There were 22 different ones of them created out of it. Southwestern Bell was the biggest. You had like 9X and Bell Atlantic, which were pretty big ones, and Bell South. Interestingly, the AT&T that we know today is actually Southwestern Bell, which then became SBC. They started rolling up a lot of the baby bells. 10 of the original 22 bells are in what's now AT&T, which also includes Bell South was the other big one that went in there. It also includes Singular, which was formerly AT&T Wireless. The hardware business was later separated into Lucent, which then merged with Alcatel and is now part of Nokia. Verizon, our other dominant phone company in the US, was also created out of the Bell system, but it was a wireless JV between Bell Atlantic and Vodafone that kind of created the name Verizon. And then eventually Bell Atlantic merged with GTE, which was like the only independent phone company in the US to become, and several years down the line, ended up buying the rest of the Verizon wireless JV. So like the two dominant companies we're left with today are effectively AT&T having been split into two, but created into this one large entity. And it's really interesting to think about how, this whole system, this whole regulated monopoly, when you injected a whole lot of change, like everything reorganized itself in all different kinds of ways. And nothing that people expected to happen out of this actually happened. And here we are today where the world's like very different. AT&T had some of the best internet technology and they never became a player in it at all. They invented, Claude Shannon invented information theory in Bell Labs. Go figure that, they really don't have, nor do the pieces have much of a role to play in this. And, I think that's just very interesting to think about it. So today, as we stare at what may be the very early stages of a push to break up our large tech companies, one has to wonder, what sort of unintended consequences might happen. And unintended consequences need not be bad things, because here, this whole system unleashed a whole lot of innovation and a whole lot of like new creations of business models and brought in a lot of new players and different avenues, and where they thought prices would rise originally, prices actually fell. What sort of unintended consequences might we be looking at if the large tech companies that exist today were to be broken up? Who would be the biggest beneficiaries? Obviously, it's hard to anticipate what new technologies and what new competitors might emerge, but it's certainly possible to think about what a company like Google, where there's a big profit center and a bunch of loss leaders, what each would look like if they had their own individual corporate mandate and imperative to kind of pursue what was best for each of them, separate and apart from what's best for, the bigger Alphabet or Google entity. You got to wonder what Amazon would look like without AWS there and being able to transfer profit pools to fund investments from one area to the next. What Instagram would look like separate from Facebook, and WhatsApp would look like as a standalone company. When the acquisitions happened, these things didn't have nearly the scale. What would happen to the whole advertising landscape? So I think it's a really interesting and fun exercise. I'm curious if you guys have, kind of studied these kinds of histories or thought about what effects, both intended and unintended, might happen if we were to break up these companies today. Is it a good idea? Is it overzealous from the regulators? AT&T in part was like, the regulators weren't necessarily pushing that hard, but it was AT&T who kept playing really, really hard with MCI, and it was a competitor who brought the action. And AT&T kind of like coaxed, almost out of hubris, the Justice Department to come after them. And the solution that ended up happening was one that was actually created and put out there by AT&T. So it's like, there are weird dynamics that happen through this all. So, curious to hear everyone's thoughts.
Well, from my standpoint, it's been impossible to not watch this kind of slow-moving train wreck of the evolution of AT&T over my investing career. And I say that because anytime I would wind up with a new client relationship, individual especially, these individual investors all had the original AT&T. They all brought these baby bells into the portfolio. And, at the point where it was obvious that the baby bells generated a lot of cash flow and didn't have a lot of use for new capital, AT&T had gone down the path. And I think you're right. It was the MCI deal, and ultimately that allowed Sprint into the equation. MCI actually, I think, carried the network for Sprint. But you had by the late 80s, kind of 6-7 years post the Baby Bell spinoffs, you had the cellular players coming into the marketplace. I mean, I had a friend of mine whose dad sold for Motorola, and he had the fancy new $4,000 or $5,000 phone. AT&T goes out and buys McCaw Cellular, and there's an evolution of acquisitions, which I've watched. I've had friends that have run the directory business for the original Southwestern Bell, which did ultimately buy AT&T and assume the name, who ultimately had the keys to the kingdom, and had this upstart Google coming into the equation. The internet was already around, and these guys were convinced that because they had boots on the ground, that Google would not be as much of a disruptor as everybody as some thought they would be. And it was only a matter of 3 or 4 years before they lost their entire business effectively. But I watched that management team at AT&T not want to make the investment. So these guys knew they had the boots on the ground in terms of the sales force. And Whitaker and the guys, the company was actually here in St. Louis. Whitaker moved them to St. Louis, and that's a funny story about not getting allowed into one of the local country clubs. So he picked up and moved the company. But he knew where the cash flow came from, but they were always trying to compete on the next iteration of what was sexy. And so that was cellular. And then at a point, so they buy McCaw Cellular. And then at a point, I guess even previous to that, they bought NCR. And it was kind of their end around way to get into competing in PCs and the Unix server market. They bought, and then they got into the cable businesses. I mean, they bought, Media One, and they bought TCI from John Malone. And, they had this era where they were going to compete in cable because that's where it was. And, they didn't see that disruption coming. And then here in the more recent iteration, they tried to do more cellular. They tried to buy T-Mobile. That got blocked. I think it was the Obama administration. But then they bought mammoth acquisitions in DirecTV, and now kind of back into the content business, buying Time Warner. 2 mammoth acquisitions. Well, I mean, DirecTV's in the middle of the cord being cut. Time Warner is sitting here in the middle of a feeding frenzy and a land grab in trying to develop content. And, it's just kind of been, like I say, an absolute train wreck. The shareholder has suffered mightily with an AT&T. And kind of back to your point, it was a regulated monopoly. I mean, they had 90% market share in the late 1960s, early 70s. And they had that whole thing with Judge Green that went on for 4 or 5 or 6 years. And I think they made bad decision after bad decision. And so you look at that through the lens of, this new, regulatory push by Congress, by the House. You've got a couple of these tech businesses, now kind of running from regulation on that front, but also thumbing their nose at Republicans. So you've got Democrats who don't like businesses with power and, very high levels of profitability that have monopolistic characteristics, nothing like AT&T's granted monopoly was. I mean, none of these businesses are even remotely close to what the monopoly was that AT&T had. But, you wonder, as big as they are and as successful as they've been, if they're not going to have both parties of Washington coming at them full force and with, barrels loaded. My sense is regulations coming, and, perhaps you're right. Perhaps you're at the point where you don't know where the next iteration of competition is going to come from. There was just a 20-year, 30-year history of not only disruption, but deprofitization with all of these businesses at AT&T, and it's been a disaster for the shareholder. And you just wonder, for how much longer can these big tech businesses that sit atop the stock market continue to win and not be regulated for it? I mean, you look at just returns this year, the 5 big companies were up 38% for the first 9 months of the year. And if you take all of the rest of the businesses in the S&P 500, they were down 4 or 5%. Well, that's been going on for 4 or 5 or 6 years. And these are mammoth businesses. And it sure looks like they've got a lot of regulatory problems, even though, like I say, they were nowhere near the monopolists that AT&T was, or even that Microsoft was. Microsoft seems to be the one that's been kind of left alone now. But they had major anti-competitive, antitrust issues, as recently as 20 years ago, 22, 25 years ago. It's going to be an interesting observation to see these things evolve here.
Yeah, I don't have a ton to add. I would say I agree that regulation is probably coming. I think that seems to be the popular mood and the politically expedient move. So that'll probably win the day. As to what should be done or what the correct course would be, that's a really hard, complicated question. And I'm probably not even remotely capable of opining in an intelligent way on that. In terms of antitrust, it's a tough argument. I mean, again, it's a complicated, deeply nuanced subject. I don't see a lot of consumer harm, at least of the typical commercial variety that you'd consider in this context. I think certain forms of big tech like social media have proven to be both very beneficial and outright poisonous to society at large, but that's kind of beyond the purview of a typical DOJ or antitrust review of competitive behavior. So, I mean, and in terms of competitive behavior, I mean, again, as I look around, somewhat anecdotally, it still seems awfully competitive out there in a lot of ways for me. So I don't know where exactly a smoking gun would emerge as it, would kind of need to force something really dramatic. You look at what Microsoft faced in Europe, maybe that's a decent precedent. Again, let's play it out to its extreme, though. I'm not sure if, to use an example I'm just completely making up, if Facebook were to be required to spin off a property like Instagram, I'm not so sure that's a horrible outcome from a shareholder's perspective, if that's what you're worried about. So I'm not a shareholder, but if I were, I just don't think that would keep me up at night. So that's about as far as I can go drawing a line.
Yeah, but that's one of the most interesting elements of it all, right? Because the fear was you break up AT&T, they said prices would get more expensive for the typical customer and shareholders would be hurt and everyone would be worse off. And in the end, actually, prices went way down on every kind of communication, partly due to innovation, which was partly enabled by, having gotten rid of a gatekeeper to the entire system. And shareholder returns went way up because these, call it 23 separate companies, the 22 Baby Bells and Ma Bell, each had their own corporate imperative that they pursued independently with their own kind of philosophy and vector for value creation. And it all ended up tying back together, but in a very different way. So yeah, I agree that it's not a worry. I mean, as a shareholder in one of these companies on the receiving end, being Google in particular, I'd almost welcome a push to kind of shake it up and break it up and kind of unleash more entrepreneurial spirits in the constituent pieces than the alternative. Though I don't know if that's the right thing to do or if it's the right, regulatory impetus.
It's interesting. The places where you've probably got more monopolistic behavior seem to be the ones that are not in the crosshairs necessarily yet. Apple, for example, to me, probably exhibits the most monopolistic behavior of the group of the 5 big techs. With the App Store, commandeering 30 or so percent. At some point, do you have an MCI that comes at them? And if the Apple controls the pipe to the house, the pipe to the consumer, the pipe to the phone, at some point, do you get a competitive push on a regulatory front? But they seem to be not in the crosshairs at this point.
Well, you do have your MCI there. They're being sued by a group who don't like the 30% tax, led by Epic Games.
Yeah, no doubt. I was talking about the MCI back to the AT&T. Back to the AT&T point, but I didn't see that Apple was necessarily in the crosshairs of the House of Representatives here on this latest iteration.
Oh yeah, I see what you mean. Yeah, they were mentioned and they were kind of given the most favorable treatment of them all. Yeah. But they do have a consortium of App Store-based based companies, Epic, Match, and a couple others that are suing them for exactly what you're calling out.
Yeah, and to me, if you're going to upgrade the phone cycle, and Microsoft did this for years and years with their Windows suite and their operating systems, if you're going to compel every 1 or 2 or 3 years and a kind of a mandatory upgrade to $1,000, now an $1,100 phone, and you effectively obsolete a piece of equipment that would otherwise and perhaps should otherwise work, that at some level that will be deemed to be monopolistic behavior. I had a totally random thought last night. I knew you were going to talk about AT&T, and I'm totally shifting gears, and apologize if I do, but I'm sitting there I was thinking through the history of all of AT&T's acquisitions and how they've pivoted and kind of how they were 5 years ahead of obsolescence or, like I say, disruption or even deprofitization. And thinking about the latest deal, you had the big Time Warner deal that was $85 or $90 billion acquisition that the DOJ actually objected to. And what do they have now? And I remembered as I was thinking about this that, you've got Netflix and, you've got Disney that's going over the top, and they've already got 60 plus million subscribers. AT&T has plans for the businesses they bought inside of Time Warner. And, you've got this land grab. And I remembered that I'd only read the first page of Daniel Loeb's Third Point letter to Disney. I don't know if you guys saw the letter. You probably did. So, he's a large shareholder of Disney now. It's his largest holding. And he's effectively gone to him and said, even though you've already cut the dividend for the pandemic, you ought to eliminate it or cut it further and take all of those cash flows and invest in content. So I read the rest of that letter last night at like 2:30 in the morning, and I thought about it and thought that to me makes no sense. I mean, this guy's classic raider behavior. And, if I were Disney, and, I could be wrong on this, and I actually started drafting a letter this morning, kind of given how I was thinking it through last night. But you think about Disney's profitability in their studio business, and, for years and years, they put out fewer movies than any other movie studio, and they always seem to have the blockbusters. So they made all the money, but they controlled content. And so to me, if you've got Netflix spending whatever it is, $13 billion, and you've got Apple now spending money producing content, and you've got inside of AT&T, their studio business producing content, there's this land grab. And Loeb made the point that if you don't get it now, you're going to lose out. And it struck me that I probably completely disagree. If I were running Disney, I would approach it from the standpoint of, I better just make sure whatever content I put out is terrific. I don't want to overdo TV shows and put out crappy content. I think if Netflix continues to spend money and they produce lousy content, you're going to lose subscribers. And so this whole concept of customer acquisition cost and lifetime value comes to me in the most valuable sense of, not necessarily outspending and not necessarily outproducing and out generating content, but ensuring that the quality is right, and then take whatever time is necessary to go through the evolutionary cord cutting process with your distribution, with your direct TVs, with your cable companies. Make the migration to live sport, but do it in a properly long sense. The problem with these raiders is, these activists is they want an immediate bang for their buck, and they've got a chart in the letter that basically shows you the PE expansion at Netflix and PE expansion at Adobe and the PE expansion at Microsoft. And to them, that's a win. If Microsoft is traded from 10 times earnings to 30 times earnings, that's what you want. But if you're a very long-term shareholder of Disney, I don't think that is what you want. So to me, it ties into the AT&T breakup evolution. It ties into what they're trying to do today, to your conversation about regulation and what's coming. And it's hard in that lens to run your business for the long term. And I think these 5 great tech companies have done that. They're probably going to wind up being penalized for it on the regulatory front. But at the end of the day, if you're a long-term shareholder in any of these businesses, you've got to get it right. I don't know if you guys have thoughts on that, my total tangent on Third Point and Loeb and Disney, but I'd be curious.
So I want to run a theory by you on Disney that I saw over Twitter. I can't remember exactly who put it out, but right away I was like, aha, that makes sense. Because when Chapek responded the next day with the content reorg, Someone said, "Oh, it's now clear in hindsight that Loeb just gave cover for Disney to make some choices that would have been a little harder to push down through the organization without having someone agitating from the outside." What do you think of that?
I don't know. I would hate to think that Loeb would have that immediate impact on the thinking in terms of major strategic decisions and the timing of how you get right the transition of going over the top. Again, I think if the world is spending tens, even hundreds of billions of dollars producing content, the vast majority of it's not going to be very good. And I would rather spend less and move the ship at the proper pace with the winds and not rush where you don't have to rush. If you've already got the king of content position and Disney is firmly entrenched there, I'd hate to think that you're going to run this thing faster than you otherwise should, but I don't know what that pace is. I mean, I'm not sitting inside Disney running it, and it's not for me to give them advice. My advice to Disney would be, do this at the pace you guys think makes sense. And I'm not sure that listening to a Danny Loeb, who not necessarily is going to be in this stock for more than 2 years, for somebody that wants to be in the stock for 20 years, perhaps your thinking ought to be different.
So I don't know that I followed then. So you think, I think I probably follow and agree with your comments about the short-termism potentially at work here. But what about the dividend? Because this is kind of getting back to what I was talking about earlier. So, and I haven't paid any real attention to Disney, so forgive me, but they suspended the dividend, or he's arguing that they should suspend it to put more money into streaming assets.
He's arguing that I think he argued that they ought to suspend the dividend, at least for the time being, and redirect all of that capital entirely into producing content to flow over the DTC channel, to flow over the Disney Plus app.
And you think that's short-sighted, or you think it's just him trying to get a pop because that'll be viewed favorably and then he'll use that pop to exit?
No, I think he sees the transformation being very profitable. I think, by controlling 100% of the margin of your content, by not running Mulan and the other movies they've announced that are going to be run outside of the cinema and bringing them directly to the app. Mulan may or may not have been a good one to do it with. I think they wanted to test the waters with that. I think Loeb's really looking for more of a short-term pop, and it may be more creative to build content quickly, but Disney's library has permanence to it. And I'm not sure the content that Netflix is building is going to have permanence. I'm not sure the content that AT&T is spending money on will have as much permanence as Disney. And so I don't think it ought to be a land grab.
It's not been their barrier to investing in more content. It's like having the right IP and the right angles to invest. So I think that was an important point you made in introducing this tangent idea, Chris. It's that, take it slow and methodically and add in the right layers to this whole OTT approach. It's not about just dumping quantities out there.
It's no different than Exxon, spending 35 or 40 billion dollars in 2014, 2015, exploring for oil when the rest of the world had gone nuts and you were going to get to a position where you were overbuilding. It's when the world is overspending and driving, in my opinion, necessarily driving returns down to unattractive levels. If you're already in an envious position of your content being the most valuable in the world, why spend for the short-term pop of having a larger library, having more shows? Because I tell you, if you put lousy content on the Disney Plus app, you're not going to have the permanent lifetime subscriber. And, at least in the kids' world, it's on a 7 or 8 year roll. But, the point is Disney's content tends to have permanence to it and nobody else's really does. And why get into a nuclear arms race when everybody else is going to outspend each other? And invariably, I don't think there's going to be a lot of success necessarily for all of the platforms that are overspending, in my opinion, today.
Yeah, that could well be. I'm not going to opine on the content, but I think the capital question is exactly right, because just as a basic housekeeping measure, if they needed capital, which apparently they don't, right? But if they ever needed capital to keep the dividend, would be insane. But it's amazing to me how many times when things get stressful, you see otherwise great companies like this just get totally befuddled by this basic question of is the dividend some sort of sacred cow? That so I thought that was maybe where Dan Loeb is trying to take this.
No, and Disney had already trimmed the dividend back for the coronavirus. The parks are closed, the studios are closed, so they've already taken the step to shrink the dividend back. I think they cut it in half, but he wants to see it cut further, and to divert spending to the immediate production of content when everybody else is overspending. You got to make sure that you're getting the best actors. You got to be sure you're getting the best producers. Equate this to pro sports, right? There's only one LeBron James. You go back to Michael Jordan, and when Nike signed Jordan, there was no number that would not have made sense to sign Michael Jordan, right? And if you're playing professional sports, everybody's a good athlete, but there's only one or two of those guys, and you better make sure you have it. And I think if you're Disney, you better make sure you're producing the blockbusters and not necessarily 15 movies a year. Phil, you've talked about short-termism on a number of our podcasts, and when I read Loeb's entire letter, I thought this guy is absolutely just looking for a quick pop and not necessarily trying to encourage the management of Disney to think in terms of a 20 or 30 year lens, which I think Disney has been doing. I think they've been properly thinking in terms of a 20 or 30 year lens. And I was stunned to see the announcement immediately in the wake of the Loeb letter. And I don't know if it was necessarily in response to the Loeb letter, but I hope it was not. I hope they're a little more long-term in their thinking there.
I believe.
I can't imagine.
Story.
Yeah. Yeah. I would say, I can point to plenty of cases where an activist has gone in to a situation like that, big or small company, and said, hey guys, we're here to help. What's going on? And management says, well, here's what we're working on. And the activist says, oh, that sounds good. And then the plan comes out and the activist takes credit for it and had nothing to do. There's no way this reorg and this shift in emphasis happened that quickly in response to a letter from Dan Loeb. That just seems to defy all.
I do believe he's there for a quick flip. The 2 times ever before this, he's jumped into companies I've been involved in. Like within a quarter of his letter, he's gone and it doesn't show up on his 13F. So that wouldn't shock me. Although it's pretty big position, but it's pretty liquid stock. You could get out of it pretty fast and a little bit of a pop.
How do you guys think that antitrust needs to evolve, perhaps? Because I think historically it was always, what's going to happen to the price the consumer is paying. And now you've got some other dynamics, like Chris, you mentioned the App Store. That's not directly the consumer, although indirectly there's a link. But maybe more importantly, we're at this point where we're aware of privacy, but we're not pricing it yet. Should privacy be something that's taken into consideration when you're talking about monopolies and antitrust here?
And there's an added wrinkle, which is typically there is a customer, but some of these businesses, they have they're 2 or even 3-sided marketplaces. And so they have more than one constituency. What might be good for one could really squeeze another. So I think, right, like in the case of an app store vendor, that's very different than someone like AT&T selling you communication services. But I'd say one farther step back in history, that's more recent history, this focus on consumer price. Like farther back, it was about excess power and how that power was exerted on various layers of various stakeholders. So I think there could be more of this approach to rethinking it in terms of how the power grid has been re-geared in the modern economy, and how power is wielded as a weapon against different stakeholders. Because I certainly think, I agree with Chris that Apple's App Store policies are about as egregious as they come. I think part of what Amazon does in their marketplace, competing, as a first party with third party after they've already, invited someone on and kind of gotten all the data and then went beneath them in price. That sure consumers win, but there are some consequences to that on innovation and access of new supply to the markets. So yeah, I do think there's room to rethink it. I definitely don't know what the right answers are. I don't even know if I should be the one putting them out there. But I don't think the existing paradigm And I think Ben Thompson's been one of the best writers on this. I don't think the existing paradigm's been written to handle today's kinds of companies.
Well, and I don't think the regulators necessarily are visionaries in terms of expecting competition that's not obviously apparent already. I mean, AT&T would not have necessarily known when the internet came along, and you had DARPANET, but then you had ARPANET in the early 80s, and right around the time of the spinoff of the Baby Bells. You had ARPANET was on the TCP/IP protocol, and ultimately you were able to run voice local long distance, over the internet, but you wouldn't have seen that coming. Cellular was coming at them, but it was early, and I'm not sure they saw that cellular was going to displace traditional landline long distance. I'm not sure they saw that the cable line coming into the house was going to be able to carry, a telephone call immediately as well. And so, the need for the breakup of AT&T was, I think, fast approaching. Its need was going away almost immediately, and you wonder if there's enough competition and disruption with the big five tech companies that the need for regulation and breaking them up, it really is superfluous and unnecessary. I think markets tend to take care of themselves, and only when it's obviously apparent that you're in a position of pure monopoly, and they tend to be granted by governments. I'd be a lot more concerned if I was a regulated electric utility today about the transition to renewables and having stranded costs in gas and coal-fired plants. If that's capital investment that was made 10 and 20 years ago, and you're not allowed to recover it over the life of the asset, the shareholder is probably more at risk there than you would be from harm of the big tech companies. And the other thing is, until very recently, these big tech companies were not that expensive, and so you could probably tolerate a little bit of regulation as well. But here in the last couple of years, they've gotten so expensive that really any threat on the regulatory front becomes that much riskier to the shareholder.
Yeah, I truly have very little to add on this topic. I agree. It's a great question, John. I think it's just really hard to answer. I think even if I were an expert, I would probably give you a on the one hand, on the other hand kind of answer that wouldn't be all that helpful.
And what do you guys think of this in a global context where, the tech companies, for better or worse, are kind of national champions, and then you got, similarly large Chinese companies, for example, and, you take something like artificial intelligence, the development of that, or just kind of having that data on, millions and millions of people and so forth. So I guess what I'm alluding to is, could the breakup impact, the U.S. more strategically?
I mean, I know that's a popular argument. I don't know if anyone knows the answer. It's not like in China, you have some of these super apps, and we haven't really ended up in that state. And maybe you even get more innovation on adding layers of functionality if some of these companies were separate instead of part of one conglomerate, like, Core Blue at Facebook and Instagram, that each could pursue their own mandate instead of kind of tinkering it in ways where, they wanted the same functionality to work on both. Or, I don't know, I'm kind of like spitballing off the top of my head, but, I think there's something to be said about internet being a land where power laws are dominant, scale truly matters. But I don't necessarily think you need all these disparate companies to exist under one umbrella to reap the benefits of scale. I think in some ways, Google proves the dismerit of that structure in their inability to generate returns on some of their non-core search forays. So, I mean, yeah, kind of like Phil said, I end up on the one hand, on the other hand, because on the other side, yeah, with data and with where things can go from here, there very well might be some missed opportunities, but certainly don't think our tech sector is lacking for international competitive prowess. We're pretty dominant outside of China. So, yeah, it's a non-answer answer, but one of the things I'm most intrigued by is when you inject major change. Interesting things happen, and with AT&T, it really actually was interesting. And I kind of think it was regulators doing the right thing, and but it was partly because regulators created the wrong structure to exist for so long. But it actually, accelerated innovation and let a lot of new things happen and created a lot of experimentation that wouldn't have otherwise had an opportunity. So maybe that helps us even better position for the future of technology. I don't really know.
All right. Well, I guess we'll wrap it up there. Guys, thank you so much for a terrific discussion. Great to have all three, and I hope all of you will be with us next week. So thanks all for listening as well. Goodbye for now.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.